What's going to be the major catalyst? Because there's so many sort of concerns about these clashing of different crises, energy costs, what's going on in China, the slowdown of the consumer. What's going to be the driving force here for the next period of time?
Yeah, good morning, Heidi. Look, many moving parts with the supply chain disruption that I think the market's on top of quite well and sending off some mixed messages. It's just in aggregate. In aggregate, we know that conditions are conducive for earnings in aggregate, US, Europe, Asia, ex-Japan, to be growing well above historical benchmarks this time next year. And currently, as is the reporting season in the US with the financials kicking off, it's running quite well in aggregate from different components. Then take a step back. People understand that they're still in this super cycle for commodities, different components of it. Energy, it's been debated for some time. Underinvestment, transition into renewables, base metals because of renewables, trading at those, some at all-time highs, some at cycle highs, and that will continue within the base metals. And then bulk commodities, a bit of a mixed bag there. Because of the underinvestment for different reasons. For thermal, they're trading at these 5-6 year highs, and coke and coal and iron ore still elevated. So the super cycle's still there as economic conditions are still expanding, even though the downgrades from the IMF, which were anticipated, were expanding economic conditions at a decreasing rate, but well above average. And because it's expected to be well above average for 22 and into 23, therefore, earnings are expanding, probably not as high as anticipated 6 months ago, but that is what you are buying today, those future earnings.
You sound like bearish. You think that bearish bets will be a little bit more commonplace going into 2022, though. What would you be shorting as part of that portfolio next year?
Yeah, it's very difficult. Obviously, shorts since 2012 have been very hard to hold for long periods of time. And buying protection for a portfolio is not cheap as well. So retracements are still an opportunity to buy, like September, NASDAQ, Dow, S&P 500 down between 4.3 and 5%. That's when you can, in those drawdowns, that's when you can participate. Buying protection on the total portfolio, expensive to fund. Still too early to be doing that at the moment. And then you're just shorting by specific names and or sectors for many different reasons. But this is still a buy the dip, structural long market because economic conditions are still expanding. Because the rate of change has been softened from these elevated levels to still elevated levels, that's still very conducive for risk assets. And that is why everyone's comfortable with the Fed being behind the curve, because they know by next year, second half of next year, they're obviously raising rates as the taper begins. So right. To make it very clear, it's still a very conducive long-only risk on buy the dip scenario, expensive to have protection at these levels still.
But for how long, given that we were just earlier talking about the surging commodity prices, and if the market would get unstable and we would see this increasing volatility, how willing would the Fed be to step back into the markets to pare back those tapering plans than it was, say, during the last cycle?
Yeah, I think the Fed's been more than clear to everybody that the tapering's beginning. It will be completed sometime mid-next year, possibly September quarter for a delay. There's a lot of liquidity in the system, and you're seeing it in evidence in the quarterly earnings coming through in the US and what's coming out of the financials, and the M&A's just these are incredible fees from M&A from US banks, and that will continue well into next year, into 23 in the non-listed and listed market. The thing to reinforce is expectations are for risk assets are understanding that you're going to have to take that liquidity out of the system. And monetary policy is not just only interest rates, it's yield curve management, quantitative easings, there's variations. The toolkit is completely different to where it was decades ago. So there's many different elements for the Federal Reserve and ECB and the Bank of England and the RBA, et cetera, to be entering into the market to transition. But it's a higher rate environment, even though real rates are low at the moment. But it's still an expanding economic condition, therefore earnings are expanding in aggregate. And yes, volatility is going to, from quarter to quarter, pick up. But that's effectively expanding earnings is the conducive environment for risk assets. Credit conditions are still quite good.